Very good morning to all. I am Professor Deepa from Department of Commerce, DBJC College. I am here to take a few overviews on financial management today. So let's move on to the slide about discussing on financial management. So the first slide, financial management. So before we move on to what is financial management, let us discuss about what is management. So I think all of you are very familiar with what is management. So management is nothing but the art of getting things done through others, right? So what is it we are going to see here in financial management is, like financial management talks about general management procedures like planning, organizing, directing, controlling and staffing. Rather, now we are going to discuss the merge of finance with the management. So this is what is financial management all about. Now going into the first slide, so as I told you, financial management is nothing but raising of funds and also the plan to utilize the raised funds. So we're going to see about what is financial management generally is allocation of funds and raising of funds. Now let's move on to the next slide, telling about the scope of financial management. Early in 70s or 80s, financial management went on with the traditional approach. So that is what is there in the slide here. So it went on with the traditional approach. So let's move on with the name. As the name indicates, it is a traditional approach, means that in early period of financial management. So what was financial management all about? In early 80s or 70s, you can see that financial management generally focused on the raising of funds. Okay, so this is what is the slide all about, procurement. So when you can see the procurement. So raising of funds is nothing but the procurement. So that is what we discussed in traditional approach. This traditional approach highly focused upon how the company would borrow funds either from outside or whatever you call it as own funds that is owned by the proprietor. Now let's move on to the next slide to see the criticisms of traditional approach. Now the first criticism is outsider looking approach. So what is outsider looking approach is, like as I told you, traditional approach focuses on borrowing of funds. So it should be borrowed from the outsiders, bankers, where you say about the outsiders looking approach, because generally in traditional approach it focused on borrowing funds from outside. The second one is it ignored routine problems. Is that only the borrowing of funds a major problem of a business? Because you have lot of enough problems to discuss on, right? So we have problems like right from the start till the distribution or till the sale ends out. You have numerous number of problems which has to be focused upon. But traditional approach, you can see it is a critic because it ignored routine problems of an enterprise. Okay, the next one. It ignored non-corporate enterprises. See, mostly this traditional approach was suitable only for the corporate enterprises. Rather, it has ignored totally the value of non-corporate enterprises who has to take up definitely also the raising of funds strategy. The next one is ignored working capital financing. As all of us know, what do you mean by working capital? Working capital is nothing but fund required to meet day-to-day expenses of an enterprise. So, if this is totally ignored, you can see that traditional approach is definitely a early period approach, right? The next one is no emphasis on allocation of funds. Is that enough? Like I should seek only the source of funds or I should allocate the funds. So allocation of funds is also a major task, right? So this traditional approach, it totally ignored the allocation of funds. Now, so let's move on to the next type of approach to see which was comfortable with financial management. So modern period. So like when I say about traditional, you should also see the modern approach. This modern approach suits also the management of finance of today. Now when you go with this modern approach, this is nothing but this an analytical way of thinking. So as we saw the criticism of traditional approach where it was ignored with the allocation of funds, this approach focused only on allocation of the funds. So to support this, like we have to see why we should take up the modern approach or why has that the trend got changed from traditional approach to modern approach of today. So today they use modern approach because of only these three reasons. The first one is the total of volume of funds an enterprise should come in. See, normally this modern approach talks about how much should be the funds. Like funds, rather there are two types of funds, that is own capital and borrowed capital. So when only borrowing from outside has become a major task in traditional approach, this modern approach concentrated also on what is owner's capital towards the business. The next one is the specific assets should an enterprise acquire. So the second one, so why modern approach is like modern approach concentrated on assets which are highly producing. Like you buy a fixed asset, this fixed asset will generate income for the company for numerous number of years, right? So that is why you take specific assets of an enterprise. The next one is funds required to be financed. So when you go about funds required to be financed, we are going to see the patterns of financing in the forthcoming slides, where we are going to see the elaborate way of explaining this funds required to be financed. Now let's move on with the decision areas. As I told you, financial management focuses on 4 decisions, which is very important for everyone to understand, to know more or in-depth knowledge about this financial management. The first one is fund requirement decision. The second one is investment decision. The third one is financing decision. And the fourth one is dividend decisions. Now let's move on quick with fund requirement decision. The first decision is fund requirement decision. This concentrates on 2 types of requirements of the firm. One is the fixed capital, other one is the working capital. So these are the 2 sensitive capital requirements in a firm, because fixed capital concentrates on deployment of funds over capital assets. And as well, when you come to this working capital, just know I have been telling about in the previous slide what is working capital. I'll repeat it again. Working capital is nothing but fund required to meet day-to-day expenses of an enterprise. So when estimation of this fixed capital requirement and working capital requirement is done by the firm, it is enough for the firm to proceed with taking up the fund requirement decision. The second one is forecasting the physical activities. Forecasting the physical activities of an enterprise. Normally, each and every physical activities has to be focused because it is involved with monetary or money. So that is why you study the physical activities here. The last one is capitalization. So it's a wide concept, but still I just want to tell you about what is capitalization. When you mix owner's capital as well as a borrowed capital and deploy it into an investment, you mean to say it is capitalized. And when you talk about capitalization, there are 2 kinds of capitalization which we should understand over this capitalization concept. Number 1 is overcapitalization and the number 2 is undercapitalization. Overcapitalization. So let me give an example. Imagine a person who is very fat. So it is about the fact of funds here, which I would like to compare, because this overcapitalization talks about the projections or the forecasting of the company towards excessive income. So where I am going to predict numerous number of values towards the business, rather the business produces only lower profit. So overcapitalization talks about overestimation of the firm for requirement of funds. And undercapitalization talks about a firm which is not so confident enough to say that they will receive more number of profits, rather in result you can see that they have received a higher profits. So this talks about undercapitalization. So when you talk about the fund requirement in capitalization concept here, you study the balanced capitalization, otherwise called as optimum capitalization of the firm. Now let's move on to the next kind of decision. The next decision is investment decision. So all of us know the basics of decision. We have 3 kinds of decision. One is short term, medium term and long term. The tenure of the short term would be 2 years. Medium term would be 2 to 5 years and long term will be 5 years and above. Now let's move on to the concept which has been discussed in the slide over investment decision. So this investment decision again talks about investing on capital and current assets. So as I told you already in the first slide, fixed capital. So here deployment of funds over capital assets. So what are capital assets? Like I invest in that asset for once and I enjoy the benefit for the lifetime of the particular fixed asset. Okay, so that is why you talk here about the capital, that is otherwise called as fixed capital. The next one is current assets. Current assets, you know, all those which are easily converted into cash, you call that as current assets. So I can list few current assets for you. Cash in hand, cash at bank, debtors, inventory or otherwise called as stock, bills receivable and all the fictitious assets. So before I move on to what is current asset in total, we are going to see what is fictitious asset. Can you please guess what could be the fictitious asset? Yes, so fictitious assets are the assets which exist in the balance sheet of the company for some period of time and suddenly disappear. Would that some portion of asset would vanish in the balance sheet? Yes, it happens in fictitious asset. That's why we study about fictitious asset under the current asset. So fictitious asset, if I say fictitious asset, outstanding income and prepaid expenses. Now let's go with an example of outstanding income. See, income outstanding, like let me say, you use the term outstanding until it is due or paid. When it is paid, the term outstanding doesn't appear, right? So that is why you call this as fictitious. Same applies to your prepaid also. When you say a term prepaid, this prepaid exists as prepaid until it is paid. So once or until the tenure comes, let me say I have prepaid my rent for next month. So this month, for this month, I have paid as well as the next month. So when it comes to next month, it is paid and it is not prepaid. So the word prepaid vanishes when the tenure arrives. So that is the reason you say fictitious assets are the assets who have the nature of suddenly disappearing from the balance sheet of the company. So those fictitious assets come under the flag of current assets. Okay. Now let's move on to the next one. To evaluate the investment proposal keeping in view of overall objectives of an enterprise. See, when you go for particularly for long-term investments, you will have to be, the decision should be very crucial because you can't change your fixed cost at any point of time. So that is the reason you say this second one as investment proposal. Okay, the next one is the study of capital budgeting concept. See, it is a wide concept in financial management to study about, but let me give you what is an explanation of what is capital budgeting. Capital budgeting, when you talk about capital budgeting, none of us would forget about time value for money, right? So time value for money. Like every time you can see that rupee 1 gets converted into lesser value every year. So when you study about the capital budgeting concept, it gives an idea to decide about selecting a proposal or a project to forecast for the future. So when, let me say I'm going to plan for a long term, or I'm going to invest for the long term, capital budgeting paves the way for a business to decide upon which proposal it would take. Okay. The next one, a detailed study of working capital management. Definitely, right? So before I go with the detailed study of working capital management, let's move on to operating cycle or business cycle. Could you please tell me what is operating cycle or business cycle? Being a commerce, definitely we study this as a basic, right? So operating cycle. So first cash will be converted into raw material. Raw material will be converted into work in progress, then to finished goods, and now the goods are ready for sale, then it will be converted into debtors. No firms like or encourage credit sale, but they are forced to, right? So when the sales become a credit sale, there arises a debtor. Now when you talk about debtor, here you study about what would be the credit period given to the customers for debtors, right? Now soon when the payment date comes or when the bills are mature for the date to payment, there arises BR after the debtors. So bills receivable gets again converted into cash. So discussing this, like cash to raw material then to work in progress to finished goods, then to debtors, then to bills receivable and again to cash. So this process takes a long time gap between each and every stage of the cycle, right? So all this time gap will be funded through working capital management. That is the reason you have to give a detailed study of working capital management, particularly for long-term investment over decisions in capital budgeting. Now let's move on to the next slide, third type of decision. Next one is financing decision. So when you talk about the financing decision, each firm has to decide how to allocate their funds, right? So allocation comes here. So when you talk about allocation, you need to study about four patterns of financing. Four patterns of financing: all equity shares, equity and preference shares, equity and debentures, and equity, preference and debentures. So these are the four patterns of financing to study about the financing decision. Now when you talk about the components of this pattern, you have equity share, you have preference shares, and you have debentures, but multiple combination under these four patterns to study the financing patterns, right? So when you see about these four financing, let me repeat it again. The first pattern is all equity shares, second pattern is equity plus preference, third is equity plus debenture, and fourth one is equity plus preference plus debenture. So, if you observe these patterns of financing, you have all equity in all the patterns of financing. Rather, others come and go, right? So, you can see you have equity proportion or equity content in all these patterns of financing. So, that is why you say firm always trades on equity. Now, let's move on to the slide of what is there here. So, first one is source from which the funds have to be raised. So, like financing decision definitely concentrates on source, because normally when we raise funds, we should not forget about the interest bearing, right? So, we have lot of interest bearing towards raising of funds. That's the reason you have to go with the source from which the funds are raised. Second one is amount that could be raised from each source. So, this is why I said amount, like when business selects multiple options to raise funds. So, they go for this amount raised through each source. Like let me say you have 10,000 source, 10,000 capital, which can be divided into 5,000 equity, 3,000 preference and 2,000 debenture. So, the segregation talks about here where you raise funds from each source. The next one is study of capital structure concept. So, when you need to study the capital structure concept, this talks about decision making on which pattern of financing to select. So, normally firms has to select any one of the 4 patterns of financing told to you now, right? So, this capital structure concept gives a clear study of what would be the pattern of financing which would suit the firm. So, decision making upon patterns of financing goes with the financing decision. Now, last one is the dividend decision. So, normally the ideology of dividend is like normally from out of the profits, some proportion of profit is distributed as dividend, right? Now, when you come to the first one, establishment of dividend policy, a firm has to establish what it would follow, whether it is going to give, like normally the percentage of preference capital would state in the articles of association of the company. So, articles is the second important document which the company should have, right? So, normally the percentage of dividend towards preference shareholders will be stated in the articles of association. So, that is the reason here you go with this decision on percentage of profit to be distributed. So, this decision on percentage of profits will be already quoted in the articles of association of the company, which serves as a secondary document for formation of a company. The next one, the study on market price of shares, trend of earnings and tax position of shareholders. So, before discussing this point, I would like to tell you about 2 theories which supports this dividend. One is relevance theory and the other one is irrelevance theory. So, when you talk about relevance theory, this relevance theory talks about distribution of dividend to the shareholders. Now, you can ask me, ma'am, dividend has to be distributed, right? But no, sometimes companies decide not to distribute dividend, which you are going to see for the next type of concept. So, first one is relevance concept. Relevance concept talks about distribution of dividend to the shareholders. Okay, so this distribution of dividend to the shareholders is supported by Walter's model of dividend and Gordon's model of dividend, which talks about distributing the promised value of dividend to the shareholders. Next comes the irrelevance theory. So, as I told you, if I say relevant is distribution of dividend, then irrelevance is going to be not distributing the dividend, right? So, irrelevance theory talks about not distributing the dividend to its shareholders. So, here comes approach, otherwise called as, popularly known as Modigliani-Miller approach. This approach talks about not distributing the dividend to the shareholders. So, when dividend is not distributed, you say a term, or this means when a dividend is not distributed, it means that it is flowing back of profit, or otherwise called as retained earnings. So, what is a retained earning? When you don't distribute dividend to the shareholders and retain it with you, you mean to say it is a retained earning, otherwise you call this as flowing back of profit. Okay, so when you study this market price, trend, tax position, then the company would take up rather the relevance concept or irrelevance concept of the dividend. Now, let's move on to the next slide. So, what is the concept discussed today? We have discussed concept like capitalization. So, what is capitalization? When you deploy the funds, both your own funds and borrowed funds into the business, you mean to say you have capitalized, right? The next one is capital structure. So, I told you about patterns of financing, where you definitely select or decide upon capital structure of the firm. The next one is capital budgeting. So, whenever the firm requires long-term investment decision or investment proposal to decide, they move on with capital budgeting. The next one is working capital management. I'll repeat it again. Working capital has a fantastic formula, current assets minus current liability. Rather, theoretically you call working capital as fund required to meet day-to-day expenses of an enterprise. The next one is retained earnings. Just now we have been discussing about retained earnings when we went on with irrelevance theory, right? So when dividend is not distributed, it is retained. So this is called as retained earnings. Next one is trading on equity. When we got to know the patterns of financing like equity plus preference, equity plus debt, or equity plus preference plus debt. Here the content of equity at every place, you mean to say the company always trades on equity. The last one is irrelevance and relevance theories of dividend, where we saw about the prominent models like Walter model, Gordon model and approach. And today we have discussed about an overview on what is financial management and what could be the scope of financial management towards traditional and modern approach. Thank you for listening. Thanks a lot. Thank you.